Hey everyone, me Kevin here. So Elon Musk just dropped the price of full self-driving to $99 per month. He left the full price option where you just pay once and then you don't have a subscription fee at $12,000, which really is probably a sign that they're not really converting many of those $12,000 individuals. And so they're purposefully leaving that price at $12K because now you're not insulting that many people who paid $12K recently, although there are going to be some. And what you're doing is you're trying to drive this value for the $99 version by showing people, look, it's going to take you like 10 years to break even if you spend $12K. So why not take this reasonably priced offer of $99? So now the question is, what is this actually going to do for the fundamentals of Tesla? Does this actually change the thesis for the stock? So what I did is I put together a spreadsheet, and we'll put it up on screen, and it is basically three different impacts that this does for the stock. Now, I purposefully went out to 2026 for this rather than going out to, 2030 or 2040 or something crazy, because I want to see what the near-term impact for the stock could be. And really the only way to do that is going out, honestly, 2.5 years is already quite a bit. The end of 2026. I think if you go out any more than that, you're not going to see that immediacy in the stock movement. And I think that's what most people care about. So let's talk about this as we look at that Florida beach. I love Florida. I grew up in Florida. Okay, so the first thing we're going to do is we're going to look at what I consider my base case scenario. And there's a big problem that a lot of people have. A lot of people are not realizing that there are costs associated with full self-driving. A lot of people think, Kevin, full self-driving is going to be 100% to the bottom line. It's the best margin driver ever. There's no capex, and it's just going to be pure profit. So there's realistic, and then there's unrealistic. And unrealistic is no cost. There's a lot of cost. You have to keep in mind, they just spent probably somewhere around $300 to $500 million buying 10,000 H100s. And guess what? Those are now the old school version of chips. Blackwell, which will be available towards the end of the year, you're probably able to train FSD 4 times as fast with some of the newest chips. So you're consistently, probably to have the latest and greatest chips, going to have to spend just on chips alone, probably, and I should just say graphic chips, which that's literally what FSD is trained off of, right? Graphics, video graphics. Like, you might be able to move some of these chat-based neural nets off of some of these GPUs in the longer term, but maybe to like A6 or something more specific to just text-based. But video neural nets, it's always going to need the latest and greatest stuff to really get better, because it's not just a matter of training it once, like getting to the version 12.3.4 that we have now. That's great, but really to iron out the rest of these edge cases, we're just going to need a lot more training, a lot more compute by using a lot more data. Like, quite frankly, the fact that 12.3.3 and 12.3.4 is making left and right turns from center lanes, totally dodging the left and right turn lanes, is weird. There should be plenty of data to tell the systems this is not what it's supposed to do. Now, I'm not saying those things aren't solvable. In fact, we could bandage them tomorrow just by writing a line of code, but that defeats the purpose. We're trying to get away from writing lines of code. So we need this data, we need the training. Frankly, we need better chips to really advance. I think one of the reasons we got to version 12, frankly, the end-to-end neural net, is because the H100s came out. And so, obviously, that's a moat for NVIDIA, but that's just going to get, as the chips get better and better, FSD will get better and better, and these edge cases will go away, but that takes CapEx. And that's what a lot of people forget, is you're probably throwing $500 to $1 billion at chips alone, once you consider that we don't just need GPUs, but we need CPUs, we need memory, we need server racks, and then we need infrastructure. And then we got to pay for that infrastructure, the electricity, the power, the people who are maintaining the servers, the people who are upgrading the servers, whatever. And then, of course, you need the R&D folks who actually implement this into the systems on Tesla vehicles, the software updates to push this to people. There's a lot that goes into it. So I think initially we're probably looking at spending quite a bit of FSD's revenues on R&D. So your AI training expense, your chips, whatever, the things I just mentioned. So I think if we go with my base case scenario, we're probably looking in 2024, if we had a 12.5% take rate. Keep in mind, that's already adjusting for the fact that some cars are never going to have FSD. Because if you have a fleet right now of about 8.5 million vehicles worldwide by the end of the year, so that's assuming, another 2 million of production, we're probably going to, and that might be generous, there's a percentage that are in other countries where we don't do FSD. There is a percentage that are scrapped vehicles that just got destroyed, obviously. And there are a percentage of people who are just never actually going to want to buy FSD because some people don't drive a lot. If I'm somebody who, if all I do is drop my kids off at school 4 minutes away and I pick them up and that's all I do twice a day, 5 days a week, do I really need FSD for 10 minutes of driving a day? No, of course not. So there's always going to be a percentage of people who won't get it. And so hence, when we factor all of these things in, the other countries, scrap vehicles, people who just refuse to get it, and people who have already paid for FSD, so you're not getting that recurring monthly revenue, you're going to be looking at probably a pretty low take rate initially. Hopefully it's in excess of 12.5%, but let's assume that it's 12.5% right now. And then what we're going to do is we're going to multiply that obviously by the $99 a month times 12, right? Okay, so let's go ahead and take a look at the base case scenario and explain how I'm doing this. So if you look at the chart, you'll see 8.5 million, it's always loud, 8.5 million fleet size multiplied by a 12.5% take rate, you get the value, how much money that could generate, $1.2 billion. Take out how much you're probably spending on AI expense. I think $800 million is quite frankly low. I think they'll probably spend more than that, but let's just say it's 70%. Divide that by shares outstanding, you're only adding about 12 cents to EPS, which adds about 4% to EPS. It basically does nothing for EPS. At some point in the longer term, honestly, I think you'll probably want to just include FSD in the actual price of the vehicle, but then margin will go up. So whether you calculate it here on take rate or you calculate it as part of vehicle margin, you have to put the value of FSD somewhere. So for 2024 on my base case, I don't really see a big move in this $99 feature. It's not as valuable as I think we hope. Now, if we go out to 2026, I think we'll be able to move that take rate to nearly a quarter of vehicles. That'll be about 22.5% of vehicles. And I think our AI expense will still be around $1 billion, 1.3 billion is what I wrote down, about 40%. And that adds 63 cents to our EPS. Which if we add a 40x multiple on that, because hopefully we're growing at, we're growing EPS at 25% a year, 1.6 peg, right? We multiply that out, we get a 40 multiple. That adds about $25 of share value to the stock in 2026, which I think is fair to look at now. In fact, I think, frankly, if we didn't have version 12 FSD, Tesla stock would probably be around $140, maybe $145. So if you look at the last 30 days, have been pretty wild for Tesla. Think about it for a moment. You went from version 11 in the last 30 days to version 12. 12.1, 12.2, 12.3, 12.3.1, 3.2, 3.3, 3.4. You got half off on monthly FSD revenue. You got an August 8th Robotaxi announcement and the potential cancellation of the $25,000 car, which I know a lot of ultra Tesla pros are like, why is everyone so concentrated on $25,000 car? Well, I'll explain that in just a moment, but the last 30 days have been crazy. And so one of the reasons Tesla stock is the fact that it's flat over the last 30 days with the horrible Q1 deliveries number is actually a sign that the market is adding back in some of the value of FSD or Robotaxi or whatever. Otherwise, the stock would be down substantially more on the delivery numbers that we had. So what does this mean? Well, this means we're probably already factoring in the base case into Tesla stock's value now. And I think what we do is we can look at bull cases and ultra bull cases. In my bull case by 2026, I think we have 35% adoption and only 20% in expenses. And that's going to drive about $52 in share value. I do not think that's being priced in right now. And then in the ultra bull case, which I personally think is unrealistic, in the ultra bull case, we're only adding about $80 a share in value. by 2026, which we would start pricing in relatively soon. Now that is pretty good, especially since I think the vehicles for the company, you're probably adding about $140 to the share price, maybe $120 to the share price. So 80 bucks should put us in the low 200s in the ultra bull case. The problem with all of this is we can't really understand what the take rates are for Tesla because they don't give that data to us. So without having that clarity, we're kind of at a loss. If we don't have the clarity on what take rates are now, then how can we know if the things we're changing, like pricing or otherwise, are actually being respected by the markets? We don't. And we don't really see a lot of FSD revenue recognition in each quarter. So it makes it very difficult as an investor to have clarity. This lack of clarity has always made me excited for the icing on the cake at Tesla, but I've always underwritten Tesla as a car company that's growing rapidly. And so for me, when we're able to grow EPS by 30% a year, well, I can give Tesla a 50 PE ratio, and when we can get to 5 million vehicles at some point in the future, you know, this is a $400, $500 stock for me, just underwriting on cars. But that thesis has fallen apart now because Elon is shifting from something that is very clear to underwrite, vehicle deliveries and a cheaper car, to we're going all in on Robotaxi. But Robotaxi comes with this massive level of investment that, first of all, we're not near Robotaxi now. We're probably 10 years away from Robotaxi. And not only are we probably 10 years away from Robotaxi, when Robotaxi first starts, you're still competing with Uber. And I know people think to this, how the hell are we competing with Uber? We're going to bankrupt Uber. They have labor. Right. But you're trying to get Uber's revenue. So if I'm going to spend 20 bucks for an Uber for, you know, a 10 or 15 minute drive or 20 minute drive, one of the reasons I'm willing to pay for that is because I value my time. And I'm not going to sit at a corner, you know, waiting for an Uber for 30 minutes or a Robotaxi for 30 minutes if I could get an Uber in 2 minutes. You need a lot of vehicles to actually get people using the Robotaxi network. You need FSD perfected, vision-based FSD perfected. We're not close to that. Then you need people saying, wow, the Robotaxi is better. I don't have to talk to a driver. It's cheaper, which that lowers your margin anyway. And I don't have to tip a driver. This is great. But they still have to manufacture the car. You know, even if you create a $30,000 Robotaxi, 80% of that car, so $24,000 of that car is still going to be cost for Tesla. We're not actually convinced they can manufacture a car for $24,000 yet. So it's not like these cars are free. And, you know, Uber's doing millions of rides a day. So in order for us to pull that off, I mean, we're going to need hundreds of thousands of vehicles. So we're going to need 1 to 2 quarters of Robotaxi vehicle production just to be able to start competing with Uber in certain markets first, where you get your delivery times down low enough at a reasonable price where people are willing to take a Tesla Robotaxi versus an Uber or a Lyft. There's a lot of competition there. So yes, even though there is a human there, and even though, you know, Uber spends somewhere around, oh boy, they've got about $37 billion of revenue. They spend about $22 billion just on the labor. So more than half is just going to the drivers, right? That's all future potential margin for Tesla, which is hopium because the price is just going to go down. The price of providing the service is just going to go down. You know, if you take $22 billion of cost away, somebody else is able to operate Uber basically for, in that case, that'd be about $15 billion. So they can drive the prices down by 50%. So the $20 ride is now a $10 ride and no tip, which is great. But again, Tesla still has to provide the actual cars. Somebody has to charge the cars. The cars have to be maintained. Who cleans the cars between each ride? The person who threw up in the back, right? And that's all assuming we're at level 5 autonomy. So, it's great, but like it's great hope. But as an investor, trying to price it in, I can't price Robotaxi in yet. I can only price in the hope of it. But what I can price in is some reasonable level of speculation on FSD, which that's why, yes, I think there is an ultra bull case where the expenses are virtually nothing for FSD and the take rates are like, you know, upwards of 45 to 65%. But I think it's heavily unrealistic. I think right now we're maybe adding 25 bucks a share. Now, the difference is if we can get EPS growth from this and we start proving, wow, we're really growing from this, then guess what happens? Instead of valuing Tesla at a 40 multiple, you start pricing it in at an 80 multiple on future growth, because now you're getting EPS growth from software, which eventually will be higher margin. They could prove, and this is the real Hopium method, they could prove to be the most profitable software AI play that exists. I actually think that there's very little profitable software right now that's AI. Maybe Palantir. It's getting windy. Palantir's an option. I think most of the companies, like the Salesforces and the MSFTs, they're trying, and I think they can probably boost their sales a little bit on Office 365. Oh, get it with AI, it's $5 more a month, whatever. Problem is, that's going to become so baseline that I'm not actually convinced you're going to see such revenue explosion at some of the core software companies now that have run as much as they have on AI. So I think those are a little bubbly. I actually like NVIDIA more than I like some of those plays. But realistically, Tesla's one of the most profitable AI plays, or will be one of the most profitable AI plays. The question is, and that's from a revenue side, the question is, how much are they going to spend to get there on CapEx? And when are we actually going to get transparency on how much EPS growth we can actually expect from these things? If Tesla can lay out a roadmap for here's how much we think we can do in earnings per share, and here's how much revenue we think we're going to make based on a certain take rate, that's when this stock can actually finally unleash and take off, because you're going to get away from just focusing on vehicle deliveries, which we know are in the toilet right now, and you can actually start underwriting. Okay, rather than just a Hopium point of view, we can actually underwrite how much can we expect to show up in earnings for this stock. Okay, Elon's done this before. He just tells us, look, we're going to target 60% take rate on new vehicles and a fleet take rate of 30%, which we want to grow to 40% over time. And then what we're going to do is, once we get this going, we're still going to focus on a compact car. It's not going to be called a Model 2 or whatever we're going to call it. Who knows, whatever. But you're going to be able to get it as Robotaxi capable of this. Or we just get a vision. Then we can actually price the stock. So that's my take. Hopefully that's useful. If it is, let me know in the comments down below. I made some money on trading some Tesla calls yesterday. It was really good. Tesla was just like straight up and down yesterday. It was down 2% on the day, but I bought it when it was down 2%. So I was arbing the difference between that 2% and like 1.75, 1.15. And we were killing it on some calls yesterday. So if you want all those buy, sell alerts and trade alerts, make sure to check the link down below. Stock Since Psychology Money.